Let's jump right into this explainer. The financial world is completely upside down right now, and we're diving straight into the sudden market chaos to figure out exactly why. Just hours ago, the whole map got redrawn. Donald Trump officially confirmed that Jerome Powell will soon be out, and his replacement for Federal Reserve Chair, well, it is definitely not who the markets were expecting. So today, we're going to break down the actual mechanics of this massive disruption, how it's fundamentally rewriting the rules of investing, and, most importantly, how you can actually use this apparent chaos to your advantage while everyone else is out there panicking. Let's get into it.
Literally the minute this announcement hit the wire, the markets absolutely panicked. We saw stocks selling off rapidly, and even traditional safe havens like gold and silver, they suffered some of their biggest historic drops. The overarching vibe right now is that the era of easy money, that comfortable environment investors have grown so used to, just vanished overnight. The market relies entirely on predictability, and this news just threw a massive wrench right into those expectations.
And the man at the absolute center of this storm is Kevin Warsh. Now, Wall Street is currently scrambling to figure him out, but he's not a newcomer by any stretch. Warsh actually served as a Fed governor back during the Great Financial Crisis. But what really has the market so incredibly spooked right now is his reputation. He brings a very specific, remarkably strict economic philosophy to the table. He is a known entity, and what he advocates for is practically the exact opposite of recent Federal Reserve policy.
This is where the massive shock to the system comes in. On one side, we have what investors were heavily conditioned to expect: bailouts, stocks only going up, and this baseline assumption that the money printer would just keep running hot straight through 2026. But on the other side, we have Kevin Warsh's actual track record. He's a hardcore hard money guy. That means he advocates for higher interest rates, he's willing to accept slower economic growth, and he wants a much stronger US dollar. So for the first time in a decade, the really comfortable, easy rules of investing are being seriously put to the test.
Now, to really understand this deep confusion rippling across Wall Street, we have to step back and impartially look at the political context leading up to this exact moment. Donald Trump has very openly and repeatedly attacked Jerome Powell's hesitation to aggressively lower interest rates. He's even used terms like lazy and called him a loser for refusing to cut those rates faster. Because of that, the clear expectation set for the market was a future filled with aggressively lowered interest rates.
So, here is the massive paradox that's currently driving everyone crazy today. We've got a direct, glaring contradiction. The stated political promise of lower interest rates is suddenly clashing head-on with the actual appointment of Kevin Warsh, who, again, is a renowned hard money advocate. Historically speaking, Warsh would literally rather see falling prices and slower growth than risk devaluing the US dollar. The market is looking at this total contradiction and just freezing up. They simply cannot reconcile the promise of easy money with the appointment of a hard money enforcer.
And that sheer uncertainty is exactly what triggers a phenomenon called market repricing. See, when the market can't reasonably predict the future, when it's faced with a massive contradiction like the one we just talked about, it has to adjust. And how does it adjust? By dropping asset prices. It basically drops the price to compensate investors for taking on the extra risk of all that uncertainty. Because above all else, the market absolutely hates unpredictability, and right now, unpredictability is pretty much the only thing on the menu.
But hold on, because history actually gives us a really clear, surprisingly optimistic playbook for moments of sudden panic like this. When something happens that the market totally doesn't expect, human emotion takes the wheel. The market almost always overshoots way too far in one direction, which is usually downward, before logic finally sets back in and things inevitably swing back to reality.
The historical numbers on this are so incredibly grounding. Check this out. Since 1980, the stock market has dropped an average of 14.1% at some point during literally every single year, without fail. It is just a completely normal part of the cycle. But here's the kicker. Despite that sharp average drop every year, in 34 of the last 45 years, the market still finished in the green. It is absolutely vital to remember this when your portfolio screen is flashing red. Temporary drops are just standard operating procedure.
Even if we look at the absolute worst-case scenario, say we see a severe market drop right alongside a broader economic recession, history still shows us a remarkably resilient pattern. Even in those super severe conditions, a historical recovery reliably happens within a 1 to 2 year window. I know the panic feels completely permanent in the moment. It always does, but the hard data proves it's almost always temporary.
So, knowing all of this rich historical context, we don't actually need to freeze up like the rest of the market. Let's break down the specific pragmatic action plan outlined in our source material to
to turn this current volatility into a distinct advantage for us. And the core message here? You really don't need to reinvent the wheel. Consistency is the ultimate key to not just surviving, but actually thriving in all this market chaos.
The foundation of this strategy is, well, it's incredibly boring, but it is wildly effective. The plan is to religiously dollar-cost average into an S&P 500 index fund. That just means you're investing a set amount on a regular schedule, totally regardless of what the news anchors are screaming about that day. You just entirely ignore the short-term market noise, because unless you're literally planning to cash out and use that money in the next few months, what the market does between now and then makes absolutely zero difference to your bottom line. Next up, the strategy calls for a slightly more modern allocation. Our source suggests increasing your allocation to a Bitcoin ETF. Now, I know some folks still view this as a bit of a gamble, but the landscape is fundamentally shifting. Institutional adoption is accelerating at a rapid pace. The strategy here views this not as a blind bet, but as a portfolio efficiency tool. It provides what we call asymmetric upside, which basically means the potential for massive explosive gains far outweighs the risk of your initial investment.
And you might be asking, why exactly should we be seeking out that asymmetric upside right now? Well, because the U.S. national debt just hit a staggering $38.7 trillion. To put that into perspective, it's a number so absolutely huge it's almost hard to comprehend. In an environment dealing with that level of systemic debt, having assets in your portfolio that operate completely outside the traditional fiat system and have the potential for explosive upside, well, it starts becoming a lot less of a luxury and a lot more of a strategic necessity.
But hey, defense is just as important as offense, right? To protect against further drops, the source outlines a highly strategic defensive position. The plan involves keeping a 25% war chest, safely parked in cash and tax-free municipal bonds, which are currently earning around 4%. This isn't just dead money sitting around. It's capital that is fully protected, generating a safe yield, and most importantly, it's ready and waiting for you to buy the dip if the market gets even crazier.
There's also a really fun, often overlooked benefit to this kind of organized financial planning. Keeping some capital aside allows you to explore highly nuanced alternative investments. It doesn't all have to be strictly index funds and bonds. For instance, the source mentions snagging an original Tommy Pickles animation cell from Rugrats for $250. When your core strategy is automated and rock solid, you actually get the freedom to invest in unique alternative assets that you just genuinely enjoy.
But listen, if you only remember one single thing from this entire explainer today, please let it be this massive, totally undeniable statistic. History proves that if you simply stay invested in the market for a 15-year period, you have a 99.8% chance of making money. I'll say that again, 99.8%. The biggest risk right now isn't owning the market. It's panic selling and missing out on the absolute best days when it inevitably recovers.
Which brings us right to our final thought. We are standing at a major crossroads of perspective here. The market is aggressively pricing in fear, but the history books tell a completely different story, one of immense opportunity. So, based on the data we've explored today, I leave you with this question to ponder. Are we truly looking at a devastating market crash driven by the Trump effect, or is all this panic simply creating the ultimate Black Friday sale for your absolute favorite long-term assets? Stick to your plan, ignore the noise, and keep learning.